Let me tell you about my Aunt Margaret. Not my actual aunt. A composite character representing every boomer who ever told me that Treasury bonds are the safest investment on earth. Margaret is 68 years old. She's been buying Treasury bonds since 1985. 30-year bonds, 20-year bonds, 10-year bonds, doesn't matter. She buys them because her financial advisor, a man in a suit who manages $400 million, told her that U.S. Treasury bonds are backed by the full faith and credit of the United States government, which means, according to him, they're as close to risk-free as you can get in this world. Gold can be stolen, he told her. Stocks can crash. Real estate can burn down. But Treasury bonds? The United States has never defaulted, not once in 250 years. It's literally the safest asset on earth. And Margaret believed him. Because why wouldn't she? The entire global financial system believes him. Every bank, every pension fund, every central bank, every economics textbook. Treasury bonds are the foundation, the bedrock, the one thing you can count on when everything else is falling apart. Except in 2024 and 2025, something absolutely hilarious happened. Treasury bonds had one of their worst performances in modern history. Not just bad, catastrophically bad. Long-term Treasury bonds lost over 20% of their value in some periods, 20%, on the safest asset on earth. Aunt Margaret watched her risk-free portfolio get demolished worse than if she'd put everything in a random tech startup. And she called her advisor, confused, angry, scared, and said, "I thought you said these were safe." And he said, with the confidence of a man who's about to lose his biggest client, "Well, they're safe from default, but not from interest rate risk, or inflation risk, or the risk that the entire $30 trillion Treasury market might be fundamentally broken. And nobody wants to admit it, because if we admit it, the entire global financial system has to acknowledge that the one asset we all agreed was safe is actually just another government promise backed by a printing press." That's what happened. The Treasury bond market, $30 trillion of supposed safety, failed. Not failed in the sense of literal default, failed in the sense that it stopped performing its primary function, preserving capital and providing safe returns. And when the safest asset on earth stops being safe, every institution that depends on it has a problem, including, hilariously, the U.S. Treasury itself. Which is why, for the first time in history, serious people in serious institutions are asking serious questions about whether the U.S. Treasury should hold Bitcoin. Not crypto bro YouTubers, not libertarian podcasters, the actual Treasury. The people who issue the bonds, asking if they should buy the thing that exists specifically to replace their bonds. Let me explain how we got here, and why this is the most important financial story of the decade that mainstream media is completely ignoring. First, let's understand what Treasury bonds are and why they matter. When the U.S. government needs money, it doesn't rob a bank or print cash directly. Well, it does print cash, but that's the Fed's job, technically different department. The Treasury borrows money by issuing bonds. You give them $1,000 today, they promise to pay you back in 10 years with interest. Simple. The bond is the IOU, the promise, the contract. And for most of modern financial history, these promises were considered absolutely rock solid. The United States has never defaulted on its debt, never missed a payment, never restructured, never said, "Sorry, we can't pay you back." Which makes Treasury bonds the global standard for safety. They're used as collateral for trillions in financial transactions. They're held by every major bank as regulatory capital. They're owned by foreign governments as reserves. They're in every pension fund, every insurance company, every sovereign wealth fund. The entire financial system runs on the assumption that Treasury bonds are safe. But here's the problem. Safe from what? Safe from default? Yes. The U.S. will always pay you back in dollars. But what if the dollars they pay you back with are worth significantly less than the dollars you gave them? What if inflation eats 30% of the purchasing power while you're waiting 10 years to get paid back? What if interest rates rise and the bond you bought at 2% yield is now worth 20% less because new bonds pay 5%? These risks were always there. We just ignored them because for 40 years, from 1980 to 2020, interest rates fell and inflation stayed low. Treasury bonds went up in value. Everyone made money. The system worked. And then 2020 happened. The Fed printed $5 trillion. The government spent $8 trillion on stimulus. Inflation came back with a vengeance. 9% CPI. Real inflation, probably 15%. And interest rates, which had been at zero for over a decade, started climbing fast. The Fed raised rates from 0.25% to 5.5% in 18 months, the fastest tightening cycle since the 1980s. And guess what happens to Treasury bonds when interest rates spike? They crash. Because if you're holding a bond that pays 2% and new bonds are paying 5%, nobody wants your bond unless you sell it at a discount. The longer the maturity, the bigger the discount. 30-year Treasury bonds got absolutely murdered. Pension funds holding long-duration bonds watched billions in value evaporate. Insurance companies took massive losses. Foreign central banks, which had accumulated trillions in Treasury reserves, suddenly found themselves sitting on huge unrealized losses. This created a crisis, not a headline-grabbing, stock market crashes 20% crisis, a quiet, slow-motion institutional crisis that most people didn't notice because it happened on balance sheets, not in the news. But the crisis was real. The safest asset on earth was losing money. And if the safest asset is losing money, what's actually safe? Let me give you the numbers because they're absolutely insane. As of January 2026, there are approximately $30 trillion in U.S. Treasury securities outstanding. $30 trillion. That's more than the GDP of the United States. That's more than the combined GDP of China and Japan. That's more than all the gold ever mined in human history. It's the largest pool of supposedly low-risk debt on the planet. And here's the beautiful, terrible truth. The system only works if people keep buying. The U.S. government runs a deficit of about $1.7 trillion per year. That means every year they need to borrow $1.7 trillion by issuing new bonds. Plus, old bonds mature and need to be rolled over. Plus, the debt keeps growing because they're paying interest on the existing debt with borrowed money. It's a Ponzi scheme, except it's legal because the government does it. For decades, this worked because there were always buyers. Foreign governments bought treasuries to hold dollar reserves. China bought treasuries to park their trade surplus. Japan bought treasuries because their yields were higher than Japanese bonds. Pension funds bought treasuries for safe income. Insurance companies bought treasuries to match liabilities. Banks bought treasuries for regulatory capital. The demand was infinite. The system worked. But in 2023 and 2024, something changed. Foreign buyers started selling. China, which had been the largest foreign holder of U.S. treasuries with over $1 trillion, started dumping. By 2025, China's holdings had fallen to around $700 billion. They sold $300 billion of treasuries. Japan, the second largest holder, stopped buying and started letting their holdings mature without replacement. Other countries followed. The foreign bid disappeared. Why? Multiple reasons. Geopolitical tensions, diversification away from dollar dependence, better opportunities elsewhere, but mostly because treasuries stopped being a good investment. When you're losing money in real terms after inflation, and your currency is depreciating against the dollar, and you're taking political risk by funding the U.S. government that might sanction you, why keep buying? So foreign demand collapsed, and domestic demand couldn't fill the gap. Banks were already stuffed with treasuries. Pension funds were already overallocated. Insurance companies were already drowning in duration risk. The only buyer left was the Fed. And the Fed was trying to tighten, not ease. They were selling treasuries, not buying. Quantitative tightening, draining liquidity, making the problem worse. This created a doom loop. Less demand for treasuries means the Treasury has to offer higher yields to attract buyers. Higher yields mean higher interest expense on the debt. Higher interest expense means bigger deficits. Bigger deficits mean more treasuries need to be issued. More treasuries issued into weak demand means even higher yields. The loop feeds itself. And here's where it gets really fun. The U.S. government's interest expense is now over $1 trillion per year. $1 trillion. Just on interest. That's more than defense spending. That's more than Medicare. It's the third largest line item in the federal budget, and it's growing. Because as old low-rate debt matures, it gets refinanced at current high rates. Every percentage point increase in average rates costs hundreds of billions in additional interest expense annually. This is unsustainable. Mathematically, provably, undeniably unsustainable. At some point, interest expense will exceed total tax revenue. At that point, the entire federal budget will be financed by borrowing, including the interest on the borrowing. That's the definition of a debt spiral. That's the end game. And the people at the Treasury know this. They're not stupid. They have the best economists, the best analysts, the best models. They can see the trajectory. They know where this goes. And they're quietly, privately, behind closed doors, starting to ask uncomfortable questions. Like, what if we can't keep issuing debt at this pace? What if foreign demand doesn't come back? What if we need an alternative reserve asset? What if we need something that isn't debt? What if we need something that can't be printed? What if we need Bitcoin? Now, let me be very clear. The U.S. Treasury has not announced any official Bitcoin reserve. They haven't made any public statements. They haven't disclosed any holdings. But here's what we know from leaks, reports, and statements from people in the room. There have been internal discussions about strategic Bitcoin reserves at the Treasury level. There have been memos circulated. There have been meetings with crypto industry leaders. There have been questions asked about custody, security, legal authority, and strategic implications. This is not speculation. This is documented. Senator Cynthia Lummis proposed the Bitcoin Strategic Reserve Act, which would authorize the Treasury to acquire 1 million Bitcoin over 5 years. The bill hasn't passed. But the fact that it was proposed by a sitting senator and taken seriously enough to get hearings tells you the conversation has shifted. 5 years ago, a senator proposing the Treasury buy Bitcoin would have been laughed out of the room. Now it's a policy debate. Multiple states have proposed or passed legislation to hold Bitcoin in state Treasury reserves. Wyoming, Texas, Florida. These aren't progressive states experimenting with new ideas. These are conservative states whose treasurers are looking at the bond market and saying, we need an alternative. And here's the really telling signal. The Treasury has started studying stablecoins. Stablecoins are dollar-backed cryptocurrencies that run on blockchain infrastructure. Why would the Treasury care about stablecoins? Because stablecoins are competition. They're a parallel dollar system that operates outside traditional banking. And if the Treasury is studying competition, that means they're worried about competition, which means they're thinking about blockchain, which means they're one step away from thinking about Bitcoin. Now let's talk about why this is inevitable, why the Treasury will eventually, reluctantly, painfully be forced to accumulate Bitcoin even though they don't want to, even though it contradicts everything they've built their careers on, even though it admits that the Treasury bond market is broken. The reason is simple: game theory. If the United States doesn't accumulate Bitcoin, someone else will. China is mining Bitcoin. Russia is mining Bitcoin. Middle Eastern sovereign wealth funds are buying Bitcoin. If Bitcoin becomes a global reserve asset and the US has zero, they've ceded monetary dominance to whoever has the most Bitcoin. That's strategically unacceptable. Here's the scenario that keeps Treasury officials up at night. What if China announces a Bitcoin reserve? What if they reveal they've been quietly accumulating for years and now hold 500,000 Bitcoin? What if they propose settling international trade in Bitcoin instead of dollars? What if the BRICS nations collectively hold more Bitcoin than the United States? At that point, the US has two choices: ignore Bitcoin and watch the dollar lose reserve currency status, or scramble to accumulate Bitcoin at much higher prices while admitting they were wrong to ignore it for so long. Neither option is good, but the second option is less bad. This is why smart people at the Treasury are quietly preparing for Bitcoin allocation, not because they believe in decentralization, not because they read the white paper and had an epiphany, but because the game theory of not having Bitcoin becomes too risky once peer nations start accumulating. And here's the beautiful irony. If the Treasury starts buying Bitcoin, they'll drive the price up, which makes it more expensive for competitors to accumulate, which strengthens the US position. It's a first mover advantage. The first major sovereign to accumulate significantly benefits most. Every sovereign after pays higher prices. So the rational move is to accumulate early, quietly, before announcing anything. Build a position while it's still cheap. Then, once you have enough, you can announce publicly and watch the price moon as other nations scramble to catch up. This is exactly what the US did with gold in the early 20th century. Accumulated massive reserves while gold was cheap, then revalued gold higher and benefited from the appreciation. Could they do the same with Bitcoin? Absolutely. Are they doing it already? Unknown. But the incentive exists. The game theory demands it. And game theory eventually wins. Now let me connect this back to the $30 trillion bond market, because that's the real forcing function. The Treasury issues bonds to fund the government. But if nobody wants the bonds, the system breaks. And right now, demand for bonds is weak. Yields are high. Losses are mounting. Foreign buyers are selling. Domestic buyers are maxed out. The Treasury needs a plan B. They need something they can point to and say, yes, we have too much debt. But we also have strategic reserves of the hardest asset on earth. We have Bitcoin. And Bitcoin is appreciating faster than our debt is growing. So our net liability position is actually improving. This is the same logic that justifies holding gold reserves. The US holds 8,000 tons of gold, worth about $600 billion at current prices. Why? Because it's a strategic reserve, a store of value, an asset that holds purchasing power when fiat currency doesn't. Bitcoin is the digital equivalent, harder than gold. More portable, more divisible, more verifiable, and its supply is absolutely fixed. 21 million, forever. If the Treasury holds even 1% of their $30 trillion in bonds as Bitcoin, that's $300 billion of Bitcoin. If Bitcoin appreciates while bonds depreciate, the ratio shifts. The Treasury's balance sheet strengthens. They can issue fewer bonds because they're gaining asset appreciation on the other side. This is not fantasy. This is portfolio management. Corporations do this. Family offices do this. Why wouldn't the Treasury? The only reason is ideological resistance. The belief that Bitcoin is fake money and Treasury bonds are real money. But when the real money loses 20% and the fake money goes up 200%, ideology loses to results. And here's the final kicker. The Treasury doesn't even need congressional approval to buy Bitcoin in small amounts. They have discretionary funds, they have investment authority, They could start accumulating today through intermediaries, and nobody would know until they disclosed it. And by the time they disclose, they'd already have the position. Am I saying the Treasury is secretly buying Bitcoin right now? No, I have no evidence of that. But I am saying the incentive structure makes it rational. The game theory demands it. The balance sheet math supports it. And history shows that governments eventually do what's rational, even if it contradicts their public statements. So what does this mean for you? It means the $30 trillion bond market is broken. It means the safest asset on earth isn't safe anymore. It means institutions are scrambling for alternatives. It means sovereign nations are thinking about Bitcoin reserves. And it means that if the US Treasury, the entity that issues the bonds, is being forced to consider Bitcoin, you should probably own some before they announce anything. Because if they announce a Bitcoin reserve, the price doesn't go up 20%. It goes up 200% overnight. Every other nation scrambles to build their own reserve. Every pension fund reallocates. Every sovereign wealth fund rebalances. And you're buying at 10 times the price you could have paid today. The bond market failed, not spectacularly, quietly, on balance sheets, in pension fund losses, in foreign central bank holdings that declined, in yields that spiked, in Aunt Margaret's portfolio that was supposed to be safe and lost 20%. The failure is real. The consequences are coming. And the Treasury, whether they admit it publicly or not, is being forced to look for alternatives. $30 trillion of debt that can't be serviced, $1 trillion of annual interest expense that keeps growing, foreign buyers that disappeared, domestic buyers that are maxed out. And across the table, 21 million Bitcoin that can't be printed, can't be inflated, can't be defaulted on, and can't be stopped. The Treasury tried to ignore Bitcoin. They called it a scam. They called it tulip mania. They called it rat poison. But when your $30 trillion bond market fails and you need an alternative, you don't get to choose based on ideology. You choose based on what works. And what works is the hardest money ever created. The train is leaving the station. The Treasury sees it. They just can't admit it yet. But admission follows recognition. And recognition has already happened. The question is not if, the question is when, and how much, and whether you're positioned before the announcement or after. Choose wisely.